Hi everybody, welcome back to the 10th of an hour with Griffin Bridgers. We've made it to episode 50. So for this episode 50, it's going to pass with little fanfare, but we're going to dive into a subject dealing with the tax effects of an estate as a designated beneficiary distributing an IRA as part of the estate administration process. And in particular, we're going to look at a recently issued private letter ruling that deals with this exact issue. Now, as always, this presentation is not intended to substitute for legal or tax advice. And before I dive into this, I'm going to mention that what we're going to deal with here is a situation where an estate is designated as a beneficiary of an IRA, but I usually like to advocate that you should avoid that outcome as much as you possibly can. In the world of IRA planning, having the estate be the designated beneficiary is possibly the worst scenario you can end up in. Now, why is that the case? Because if a non-individual like an estate or a charity is the beneficiary of an IRA, the required minimum distribution rules limit the distribution horizon of that IRA. So usually if you have an individual beneficiary and things are done right, you can stretch IRA distributions over the life of that individual beneficiary if they're an eligible designated beneficiary under the Secure Act. And if not, you can at least defer the liquidation of the IRA for 10 years. But in the case of an estate or other entity like a charity as an IRA beneficiary, and sometimes a trust, you have to liquidate the IRA by the end of the calendar year containing the 5th anniversary of the IRA owner's death. But a practical problem here is that most estates do not stay open for 5 years. So the big question is, one, does the personal representative or executor of the estate have to keep the estate open for 5 years to avoid some sort of tax liability that may be avoidable or deferrable? Or must the personal representative or executor liquidate the IRA early and generate a huge upfront tax cost? Keep in mind that in doing this, the tax brackets for an estate are highly compressed as well, which increases the tax if you compare liquidating an IRA payable to an individual as opposed to an IRA payable to an entity like the estate. Or instead, could the estate distribute the IRA to an estate or to the estate beneficiaries, maybe by making a trustee-to-trustee transfer of IRA funds to new fractional IRAs in the name of the beneficiaries of the estate? Now, a recent private letter ruling, 2020-39002, illustrated this point, and the IRS looked at this and said that there is no taxable income to the estate in this situation, that the personal representative of the estate is free to make a trustee-to-trustee transfer or initiate that type of transfer into IRAs for the benefit of the heirs of the estate. And that helps to avoid the tax issue of keeping the estate open for 5 years, as well as the administrative issue of keeping it open for 5 years as well. Now, it's important to note that this ruling was very narrow. It only focuses on this specific point. There are several things not addressed here. One I cite, and I don't have the materials in front of me to dive into this in detail, is that we need to know who the estate beneficiaries are. There is one instance where the IRS has privately ruled that where an IRA was payable to the estate as beneficiary, that IRA could qualify for a spousal stretch when the IRA is distributed to the spouse as the sole beneficiary of the estate. And that's not addressed here. We don't know if any of the heirs of the estate in this ruling were the spouse or if they were just children or otherwise. But the IRS hasn't gone as far with a non-spouse beneficiary, I don't believe. If you know of that, let me know. But as far as I know, a non-spouse beneficiary can't then use their own life expectancy to calculate RMDs for an IRA distributed out of an estate where the estate was the beneficiary. Now, another issue here is that the estate in this case would have been entitled to use the IRA funds to pay estate expenses, but the estate would have been taxed if the IRA funds had been withdrawn for that purpose. And importantly, on that previous point, for example, if the spouse were the sole estate beneficiary, the estate's use of those IRA funds would probably disqualify it from a direct distribution, trustee to trustee transfer out to the spouse, and you wouldn't have been able to substitute the spouse's life expectancy for RMD calculations in that sort of a situation. And then finally, I think it's important to look if you are familiar with the calculation of estate or trust income. There's this concept of distributable net income that says that the estate or trust gets a deduction for any income that's actually distributed out to beneficiaries. That deduction is known as D&I, or distributable net income, and it would usually include IRA distributions. So the big question is, was this essentially a wasted ruling? Because if the estate had to liquidate this IRA and distribute funds out, then it could have just taken a D&I deduction if that distribution had been in the same year, and the beneficiaries of the estate would have been taxed on those IRA distributions at their normal income tax rates, which would usually be lower rates than those applicable to the estate. So at least one of the points there could have been avoided. But I digress. This was a very narrow ruling, as I mentioned, and there's a lot of gray areas. And another blind spot not even addressed here is a couple unsettled issues dealing with bequests and the satisfaction of bequest using an IRA. So, for example, if you have a dollar amount that has to be distributed to somebody under a will or a trust, and an IRA or a fraction of an IRA is used to satisfy that, even if it's just a simple trustee to trustee transfer that results in no distribution from the IRA, there's a lot of practitioners out there that theorize that that type of a situation would accelerate the taxation of that fractional share of the IRA that's being distributed, and would cause it to be taxable as income in respect of a decedent, or IRD. Now, in this case, since the estate was split three ways, this wasn't technically a pecuniary bequest, so this wouldn't have been an issue here, because typically where this could potentially arise is when a dollar amount figure is satisfied with an interest in an IRA, and not in a situation where a percent or fractional figure is satisfied with an IRA. Now, it's splitting hairs in terms of the difference, but it is different in the eyes of the IRS and under the IRD rules. Now, one big question that comes up here, however, that's unsettled and that we'll talk about at a different time is, what about formula clauses in wills or trusts for estate tax purposes? So, for example, if you have a will or trust that has maybe the exemption equivalent of 11.58 million, first going to, say, a family trust, and then the excess going to marital trust, then could the use of an IRA to satisfy that pecuniary portion of the formula cause a tax issue through this acceleration of the undistributed tax deferred portion of the IRA? But that's something that is a subject for another time, because there are many more episodes of the 10th of an hour to come. This is episode 50, but I plan to keep on doing this for as long as I can, and as long as I can keep coming up with good material. But for that matter, you as a listener, I'm reliant on you, so as I always close out these episodes, I recommend that if you have questions or topic suggestions, you email those to me at griffin.bridgers@gmail.com. Thank you again for listening to this episode of the 10th of an hour, and I look forward to seeing you in the next 50. Thank you.